Lecture 8. Classical Alternatives, Transparency, and Close. This lesson is part of the course Islamic Banking and the Sabbath Pawn Test. It follows the scholarly preprint closely and presents the argument as research analysis, not as a fatwa and not as personal financial advice. The final lecture turns from critique to constructive alternatives, course conclusion, and disclaimer. 6. Classical Alternatives and Solutions. The early Muslim community, guided by the Quranic worldview and prophetic example, developed financial practices that avoided riba while facilitating trade, home ownership, agriculture, and public needs. In light of the issues identified with some modern Islamic banking products, these classical alternatives are worth reviving and adapting. They emphasize transparency, risk-sharing, and social welfare, focusing on substance over form. 6.1. Musharakah, Partnership Financing. Musharakah is a joint venture or partnership where all partners contribute capital and share in profit and loss according to agreed ratios. Unlike a loan, there is no guaranteed return for any partner. Returns depend on the success of the venture. This was a common financing method in the Prophet's time and afterwards. For example, merchants would pool funds to finance a caravan and then share the profits when the goods were sold. In a home context, partnerships can be used, as in diminishing musharakah, ideally in its pure form, so that if someone needs funding to buy a property or expand a business, an investor provides capital in exchange for an equity share, rather than a fixed debt. Profit is shared through rental yields or business income, and losses are likewise shared. This aligns with the Quranic injunction that trade is permitted, Quran 2:275. Trade here including ventures where capital and labor cooperate for profit. It eliminates the injustice of one party gaining a sure profit while the other bears all risk. In practice, equity financing has drawbacks. Partners need trust, and investors often prefer the certainty of debt. But classical scholars like Imam Malik and Abu Hanifa actually favored partnerships and profit-sharing arrangements. They only permitted credit sales, like Mudarabah, within certain limits because not everyone can do partnership for every transaction. The Islamic ideal economy is one where capital is frequently invested on a profit and loss basis, Mudarabah or Musharakah, generating real economic activity rather than loaned at interest. For instance, instead of Ahmed in the case study dealing with a bank, he could have made a Musharakah deal with an investor. The investor gives $50,000 and becomes 25% co-owner permanently, entitled to 25% of any rent or sale price. Ahmed gets to use $50,000 without a debt. Later, if he wants, he can buy that share back at market value or share the house's appreciation. Both share risk. If the house value falls, the investor's share value falls too. This is fair and riba-free, though from Ahmed's perspective, he's giving up some home equity upside. But that's the cost of risk sharing. It's not risk-free for either side, unlike a riba loan which puts risk disproportionately on the borrower. 6.2. Mudarabah, Investment Trust, Passive-Active Partnership. Mudarabah is a special type of partnership where one party provides capital, rabal mal, and the other provides labor/management, Mudarabah. Profits are shared per agreement, e.g., 50-50, and losses, if any, are borne by the capital provider alone. The manager loses the effort/time, the investor loses money. This was the basis of many trading journeys in early Islam. For example, some reports indicate that Khadijah, may Allah be pleased with him, employed the young Muhammad, peace be upon him, on a Mudarabah. She gave capital and he traded with it, sharing the profit. Such equity-like arrangements remove the injustice of a debtor owing money no matter what. Instead, if business yields profit, both gain. If it yields none, the financier doesn't get a return. This encourages financing of productive ventures and aligns with ethical norms. In modern banking, true Mudarabah could be used for venture capital, SME financing, etc., And indeed, Islamic banks do use Mudarabah on the deposit side. Many savings accounts are nominally Mudarabah, where the depositor is investor and bank is manager sharing profits. However, Mudarabah financing to entrepreneurs is still relatively rare, partly because banks and regulators prefer safer, collateralized modes. Classical jurists extensively discussed Mudarabah rules, ensuring trust and transparency. Notably, the Prophet, peace be upon him, and companions upheld that the Mudarib cannot guarantee a fixed profit. Any such guarantee would make it a disguised loan, hence riba. This informs us that any promise of principal protection or fixed return invalidates the Mudarabah. Islamic banks sometimes struggle with this, as depositors want guarantees, but strictly speaking, a Mudarabah account can lose money. In practice, banks quietly forego fees or dip into reserves to smooth returns and avoid negative profits to depositors. This again is a modern accommodation, but ideally, the principle of profit-loss sharing should be maintained to keep the arrangement halal and in spirit. 6.3. Interest-free loans, Qard Hasan, and public funds. In an Islamic system, loans were not a tool for profit. They were an act of benevolence or a means of need fulfillment. The very term Qard Hasan means benevolent loan. The Quran uses it in praising those who lend to others, seeking Allah's pleasure. Quran 2:245, 57:11. The Prophet, peace be upon him, highly encouraged lending without interest, and warned that taking even a small gift or advantage in return for a loan could count as riba. Given this ethos, Muslim societies developed mechanisms for interest-free finance, particularly for the poor. One major mechanism was zakat. One of its 8 categories is al-gharamin, people in debt. This means a portion of the mandatory charity is explicitly meant to pay off debts of those overwhelmed, effectively an interest-free bailout. This prevents a permanent debtor class and shows how Islamic law tackles debt not by refinancing it with interest, but by forgiving or relieving it. Another mechanism, the Bait al-Mal, public treasury, in early Islam would sometimes provide Qard Hasan. As noted, Caliph Umar created an early form of loan program for farmers who couldn't pay tax due to hard times. He loaned them funds to invest in their land with the expectation of repayment when able. Abu Ubaid, 2007. Importantly, these loans had no interest. They were essentially government-backed credit lines solely aiming to prop up citizens, not to generate revenue. Contrast this with modern states that often themselves borrow on interest or facilitate interest-based microloans. The Islamic model was interest-free aid. In modern application, one could envision an Islamic bank or an Islamic state running Qard Hasan funds for essential needs, education, medical, small business startup. Indeed, some Islamic banks allocate a charity fund from non-halal income or late payment fees, and use it to give Qard Hasan to needy students or patients. While not profitable, these uphold the prophetic model and build goodwill. Moreover, charitable endowments, waqf, historically played a huge role in providing social services without interest. For example, waqf money was used to set up free hostels, hospitals, and even no-interest loan funds. A waqf might lend money from its corpus to people and revolve the fund. Today's Islamic finance could incorporate fintech-driven Qard Hasan pools or community crowdfunding for loans, truly eliminating riba where possible rather than finding a substitute for it. 6.4. Public infrastructure via taxation, not borrowing. Another classical alternative seen was financing public projects, roads, canals, fortifications, through tax or revenue share, not by borrowing on interest. The concept of a government bond paying interest was unknown in the Islamic Golden Age. If money was needed, they either raised taxes with Sharia limits and social justice in mind, or solicited voluntary contributions from the wealthy. Sometimes sukuk-like arrangements were used, e.g., granting someone the right to a revenue stream in exchange for upfront investment, But these were asset/revenue based, not simple interest debts. The modern Islamic finance industry has created sukuk, Islamic bonds, to finance government needs, structured variously on lease or partnership formats. When done correctly, these sukuk represent investment in an underlying asset. For instance, the government sells a share of an asset's usufruct to investors and rents it back. This is much closer to equity or asset financing than pure debt. The key difference: in classical times, if a state asset did not produce the expected revenue, the sukuk holder would have to take that loss, risk, whereas a conventional bondholder would still claim interest. By reintroducing risk-sharing at state level, Islamic finance can avoid burdening citizens with compounding interest liabilities and instead tie returns to actual development outcomes. One might ask, can banks survive without ever charging something like interest? The classical answer is that banks per se didn't exist. There were money changers and merchant financiers who operated on profit share or service fees. In a modern sense, Islamic banks can survive by charging fees for services and profits from investments, rather than pure interest on loans. Many are already profitable by trading, Mudarabah, and leasing, ijara, as we've discussed, which are permissible modes if done right. They also earn fees on services like remittances, guarantees, etc. The challenge is to maximize the truly risk-sharing financing and minimize the replicated interest financing. 6.5. Transparency and community oversight. A softer but vital alternative is the approach to transparency that classical scholars insisted upon. Transactions were to be clearly documented, as in Quran 2:282, the longest verse, commanding writing of debts. Quran 2:282, and any oppressive clause should be avoided. A classical Islamic contract is relatively straightforward. It wasn't engineered by teams of lawyers to exploit loopholes. The Prophet, peace be upon him, said, "Muslims are bound by their conditions, except a condition that makes the lawful unlawful or the unlawful lawful." By this standard, a condition inserted to basically make riba halal, e.g., the lessee will compensate the lessor exactly for any loss so that the lessor's profit is assured, would be void. Islamic banks should embrace simplicity and clarity. If something looks like a duck, walks like a duck, interest, perhaps it's better to call it and avoid it, rather than hide it under layers of complexity. This is more of a moral alternative. The alternative to questionable halal is forthright compliance and seeking genuine halal avenues. In sum, classical Islamic economics offers authentic modes of financing founded on justice. Musharakah and Mudarabah turn financiers into partners who sink or swim with the entrepreneur, aligning incentives and sharing burdens. Interest-free lending, Qard Hasan, fosters compassion and community, saving the poor from spirals of debt. Use of zakat and endowments ensures the indigent and indebted get relief, not exploitation. And a tax and spend model for public finance avoids enslaving the populace to creditors. These alternatives may not always be as immediately lucrative or convenient as an interest-based loan, but they carry the barakah, blessing, of conformity to divine principles and the ethical higher ground of not preying on vulnerability or time value alone. Modern Islamic finance is entirely capable of implementing these. Indeed, a few institutions and fintech startups are exploring profit-sharing fintech, cooperative housing purchase models, and charitable microfinance. With innovation and sincerity, the industry can move closer to these classical ideals, thereby truly setting itself apart from conventional banking in practice, not just in branding. 7. Conclusion. Islamic banking stands at a pivotal juncture where it must choose between two paradigms: merely reproducing conventional financial products with Islamic legal terminology, or embracing the transformative economic vision that the Quran and Sunnah outline. This study, through the Sabbath pawn test metaphor, has illustrated that adhering only to contractual form while neglecting economic substance risks breaching the very prohibition Islamic finance was created to avoid. If an Islamic bank's product yields the same outcome as a riba-based loan, a fixed, risk-free return to the financier and a transfer of all risk to the client, then, as our classical sources warn, such a practice may be riba in everything but name. Allah knows what you conceal and what you reveal, says the Quran, and Allah is not in need of your deceptive oaths, an allusion to those who would swear to false contracts. The message is that one cannot fool God with legalistic trickery. Our evaluation of Mizan Bank's products revealed both commendable efforts and areas of concern. On one hand, modes like diminishing Musharakah and Ijara have the potential to embody true partnership and fairness, reflecting the Quranic principles of mutual benefit and leniency to debtors. Quran 2:278, 2:280. On the other hand, when those modes are executed with an aim to guarantee the bank a profit come what may, they start to mirror the Jahiliyyah interest-based transactions that Islam abolished. Al-Jassas, 1992. The case study of an Islamic mortgage alternative showed how easily a sequence of halal contracts can be orchestrated to produce a haram result, unless diligent oversight and intention guard against it. Crucially, intent and transparency differentiate a truly Islamic transaction from a legal ruse. In Islamic law, actions are judged by intentions. A sale intended as a sale is halal. A sale intended as a loan with interest is not, even if the contract technically is a sale. Modern Islamic financial institutions must therefore inculcate a culture of genuine compliance. This means Sharia boards and management should ask, not just, is this contract valid on paper, but also, what are we really trying to do here, and is it in the spirit of Sharia? They should recall the example of the Sabbath breakers, who likely rationalize their actions. We are still observing Sabbath. We only set out nets, not fishing. An Islamic bank should avoid analogous rationalizations for riba-like outcomes. We are not charging interest, only profit on a sale, if those ring hollow in economic reality. Another conclusion from our classical survey is the emphasis on justice and compassion. The prohibition of riba is intertwined with establishing justice, so that lenders do not oppress borrowers, wealth does not concentrate unfairly, and transactions do not devour others' wealth wrongfully. Quran 2:188, 29. Thus, Islamic finance's success should not be measured solely by how many conventional products it can imitate competitively, but by how much positive difference it makes in people's lives by embodying Islamic values, promoting entrepreneurship, sharing risk, easing the burden on the indebted, and circulating wealth into productive use. The historical practices of giving interest-free loans and using zakat for debtors remind us that sometimes the best Islamic financial product is charity or kindness, not a complex contract. Commercial Islamic banks, of course, are businesses, but they can still prioritize charity via Qard Hasan funds and by taking a sympathetic approach to clients in hardship, e.g., foregoing rental profit during moratoria, something some Islamic banks did during the COVID-19 crisis as a goodwill gesture aligned with Quranic directives. Quran 2:280. In conclusion, the way forward for Islamic banking and finance is to return to first principles. By re-evaluating modern structures through classical knowledge, as we have done here, the industry can identify where it has strayed into mere formality and pull back. It can innovate true alternatives like equity-based financing for home ownership, cooperative housing schemes, profit and loss sharing investment account for deposits, and social finance for the needy, which fulfill the maqasid objectives of the Sharia: justice, welfare, and preventing harm. The goal should be to make Islamic finance not just Islamically acceptable, but Islamically beneficial, a means to enhance socioeconomic justice and remove the poison of riba from our communities in both letter and spirit. The Sabbath pond of riba will catch unwary fish if Muslims only focus on moving the net. Instead, we must heed the Quran's call: O you who believe, fear Allah and give up what remains of riba, if you are truly believers. Quran 2:278. Giving it up means not reintroducing it via backdoors. It means striving for financial practices that are equitable and transparent. Islamic banking can lead this charge, but it must embrace bold changes and possibly short-term sacrifices in profit models to realize the long-term blessings of a riba-free economy. In the end, success in this endeavor requires collective effort. Scholars, practitioners, regulators, and customers all have roles to ensure that the promise of Islamic finance is fulfilled in substance. Only then will Islamic banking fully distinguish itself from conventional banking and silence its skeptics. And only then can it claim to have passed the Sabbath pawn test by not only avoiding the letter of riba, but also its essence, thereby earning the pleasure of Allah, SWT, and contributing to a more just financial system for humanity. 8. Disclaimer. Nota bene. This paper is a scholarly examination and is not a fatwa or final religious verdict. The analyses and interpretations offered herein represent an academic attempt to correlate classical Islamic jurisprudence with contemporary practices. Banking products and contracts can be complex, and their Sharia compliance may involve nuanced details not fully captured above. Readers are cautioned to not self-judge the validity of any financial contract without consulting qualified Sharia scholars who can assess specific cases. The opinions expressed are subject to further scholarly debate and critique. In the tradition of Islamic scholarship, which welcomes dialogue, shura, and differing juristic viewpoints, ikhtilaf, the author's aim is to encourage transparency and sincerity in Islamic finance, in hopes that any gaps between form and substance can be bridged through collective effort. Constructive feedback from experts in Islamic law, economics, and finance is welcomed so that this important discourse continues to evolve. Ultimately, any goodness or accuracy in this work is from Allah, and any mistakes are the author's own. This research is intended purely to advance understanding and is not to be taken as personal financial advice. May Allah reward the sincere efforts of all those striving to eliminate riba and bless our economic transactions with justice and barakah. As you listen, keep the course question in view. Does the structure change the economic substance, or does it only change the route by which the same result is reached? This completes the course. The paper's final caution remains important. This is scholarly analysis, not a fatwa, and not personal financial advice. Specific contracts should be reviewed with qualified Sharia scholars and competent financial professionals.